April 29th, 2026. Robinhood just released its Q1 numbers, and the headline is brutal. Crypto revenue down 47% year over year. Despite a record 4.3 million gold subscribers, the meme stock engine is officially sputtering, with the stock cratering 12% today. But while the retail crowd panics, a massive shift in the balance sheet may explain why the big banks aren't selling. Today, we're auditing the Robinhood wreckage to see if Vlad Tenev's super app pivot as a masterstroke or a desperate Hail Mary. Most people know Robinhood as the app that broke the stock market in 2021. But the company we're auditing today is unrecognizable from the one that started in a Menlo Park garage. With 4.3 million gold subscribers and a 12% earnings crash just 24 hours ago, the ticker detective is opening the file on the most controversial broker in history. Who is Robinhood really, and why is Wall Street suddenly betting on their platinum future? The motive was simple. In 2013, two Stanford roommates saw the big banks as gatekeepers. Their mission? Democratize finance for all. They pioneered commission-free trading, a move that forced giants like Schwab and Fidelity to bend the knee. But as a detective, I look at the fine print. Free trading was fueled by payment for order flow, PFOF, selling your data to market makers. They didn't just open the gates, they built a toll road that most users didn't even know they were paying for. If you think Robinhood is still a trading app, you've lost the trail. In 2026, transaction revenue is actually their smallest engine. The real money is in the super app pivot. We're talking about a 3% IRA match, high-yield cash accounts, and a $695 a year platinum card. They are successfully moving from retail gamblers to wealth management. They currently hold nearly $130 billion in assets under custody. They aren't fighting for your $10 Dogecoin bet anymore. They are fighting for your retirement. Let's follow the money. For years, crypto was the high-octane fuel, the entire lifeblood of this stock. But today, it's a liability, and the engine stalled. Crypto revenue didn't just dip, it plunged 47% year over year, with the nominal volume falling to $24 billion. Why? Well, that's the forensic twist. Equities revenue surged 46% because the retail crowd is moving to prediction markets and index options, which Robinhood is still trying to scale. Robinhood is attempting to turn gamblers into investors. They've matured, but they missed EPS by 7%, coming in at 38 cents. The market isn't just punishing the miss, it's questioning if Robinhood can survive without the meme stock volatility. But here is the evidence the bears are ignoring: the platinum pivot. The real story isn't the trading, it's the subscriptions. Robinhood is currently spending $2.7 billion in operating expenses to hunt the whales. They just launched an invite-only $695 a year platinum card with the 3% IRA match, a $250 autonomous rideshare credit, and a $500 hotel credit. They aren't an app for broke traders anymore. They're building a gated community. Gold subscribers are up 36% to a record 4.3 million. This is a total identity shift from transaction app to subscription powerhouse. This is a massive bet on becoming the Apple of finance. But is the average user worth the $157 they're currently generating? Robinhood is no longer the sheriff of Nottingham's enemy. They are becoming the bank, contrary to their startup motive in 2013. Analysts at Citizens are still holding a $155 price target, calling this dip directionally soft but fundamentally intact. But the market is pricing in a post-hype hangover. The detective's verdict? Robinhood is currently a Rule of 40 company with a massive 56% adjusted EBITDA margin over the last year. Yesterday's 12% crash was a reaction to the old Robinhood, the crypto volatility. But the detective's eyes are on the 56% adjusted EBITDA margins. If you're looking for a crypto play, Hood is dead. But if you're looking for a diversified financial super app trading at a 40% discount to its 52-week high, the evidence points to a massive re-rating by Q4. If you believe in the Platinum Super app, this 12% crash is the entry point of the decade. If you think they're still just a crypto casino, the evidence says stay away. What's your verdict? Are you buying the $74 floor, waiting for $60? Or do you think the Platinum pivot is a desperate attempt to shake the meme stigma? Let me know your thoughts in the comments.